If you own a legal firm and are paying over $200,000 a year on taxes, then you are in the right place. The bad thing is you're being overpaid on taxes. The good thing is I'm going to show you how to save your taxes by 50%. Let's go. All right, so let's get into how $250,000 a year minimum is disappearing out of your bank account to Uncle Sam, how to cut your tax bill in half, and how to use that by doing structures over loopholes. Right? I'm Casey Chauhan, founder of Together CFO. I've helped over 287 business owners, legal firm owners just like you save over $47 million a year on taxes and growing every single year. Fantastic. I'm also a writer for Forbes magazine, and I am going to show you what your CPA doesn't even know. Your CPA might be excellent at what they do, but chances are they are very reactive rather than proactive. That's the first biggest thing that we see is they're doing things after the clock has already run out. We are doing it before it's even started and along the way to save you the most amount of money. So the CPA is usually good for a smaller business doing 2 million or less because they're a generalist, not a specialist, right? They generalize in a little bit of tax here and there and loopholes, but once you get past a $2 million revenue number and you start make multi-7, multi-8 figures in your revenue, chances are you're running out of loopholes really quick and you need a tax specialist rather than a tax generalist. And that's where we come in. So the loopholes are good to save you maybe 5 or 10% a year on taxes, whereas structures can go from saving you 30 to 60%, which is a huge difference, night and day difference. And we're going to show you how all that works. The hidden cost, let's say as an example, you were paying over $500,000 a year annually in taxes. That times by 10 would make a $5 million loss that you've overpaid and over donated to the government, not to factor in compounding where it's even more, right? So now you're talking tens of millions of dollars that you've donated that you didn't have to, that you've done, all because you didn't have the right team around you. So think of it as the team that's got you from where you were to where you are now isn't the same team that's going to get you to where you want to be in the future, right? As you get bigger, as you scale, you need better team around you. And the principle that we use is all based on the Rockefellers, right? So the Rockefellers say to own nothing and control everything. Sounds great in principle, but how do we put it into practice, right? So ownership equals taxation. So if you own something, then the taxation will follow the ownership. But there's no mention of control, right? Power without liability is really what we're trying to get to. And we're going to show you how that works, right? But first, let's share what the IRS's statement is. They want you to pay your fair share, right? And what should your fair share be? I'm guessing right now it's in the 30s, maybe 40% tax rate when you look at how much you're really making versus how much a check you have to cut to Uncle Sam every year. So it's all hidden in 80,000 pages of tax returns, and the billionaires from their leaked returns on ProPublica, go Google it, ProPublica leaked tax returns, you'll see that these billionaires are all paying 1% or less effective tax rate, which is nuts. Imagine what you could do with those funds for you and your family and your future family if you were only paying a 1% tax rate, right? That's a lot of additional wealth that you can then invest in, grow your law practice, stocks, bonds, real estate, all these types of things, crypto, whatever it is that you're into, you could become a lot wealthier sooner if you were only paying a 1% tax rate like these guys. We're going to show you the structures that they use. And again, it's not about the temporary loopholes that can save you 5 to 10%. We're going to focus on the key things, the structures that save you 30 to 60%. If your CPA has ever said to you, there's nothing more that we can do, you need to find a new CPA, right? Because there's wealthy people out there that have these structures set up, all completely legal, but it is only for a certain type of person, right? It's not a level playing field, unfortunately, because the billionaires all know how to do this. And what we're going to do is bridge that gap between the billionaires and the multimillionaires and drag your tax savings up to their level, right? How it works, it's only for business owners that are doing over $2 million a year in revenue. Ideally, between 2 and 50 million is the sweet spot. Anything above that, you can start looking into family offices and having a whole team of dedicated people do this for you. Also, your tax bill must be over 200k per year, and you must be a business owner or selling a significant asset, whether that's stocks, whether it's crypto, whether it's real estate, just creating a capital gain pretty much, right? What disqualifies you is if you're allergic to paperwork. There is a lot of T's and C's that need to be done here. If you are mixing, commingling funds, big no-no. Again, be on top of your compliance. And if you're looking for a magic bullet that can get you to 0% tax, then please let me know what that is. I don't think it exists, but if you think it does, show me. I would love to see it, right? I'm not seeing it in the 10 years that I've been doing this, but you never know. All right, let's get into it. The Strategic Giving Partnership. What is it? What entity is it? I know you've all been thinking about it. It is a limited partnership. What does that mean? It means it has at least 2 partners that own this. One is usually called the general partner that takes care of day-to-day business and is in full control of decision making, and the other is called the limited partner and is a silent partner, doesn't do anything. The key is for you to be the general partner but own 1%, which gives you full control and low taxation, compared to your limited partner, which could be a charity as an example, which could be a 99% owner but a limited partner, so has no power, no control whatsoever. That's the ideal state to get to reduce your tax bill but still have 100% control. Now, I've been throwing a lot of words at you there, so let's see how that works in an example. So imagine if your net profit after everything was $2 million, right? And in a normal world, you would pay 35% tax rate. That's $700,000 that you would pay on that. Wow, it's a lot of money, right? So with the Strategic Giving Partnership, just as an example, you could pay as little as $7,000 in your taxes. So that's a saving of $693,000 a year. Now, you can extrapolate this math and kind of adjust it for your own businesses. I just wanted to show you how powerful this tool can be if used correctly on that amount of savings. So that is a $693,000 saving on a $2 million profit, right? So that's huge. Imagine how much revenue you'd have to add to your top line business to make an additional $393,000 after tax. We're talking multi-millions here. It's at least $2 to $3 million of additional revenue you'd have to generate in order to make that much after tax savings. And how does it all work? It's all about control versus ownership. We're talking about deeper level stuff, right? So you stay in control, you receive a K1 for 1%, the charity would receive a K1 for 99% as a silent partner without having any distributions. Let's use an example. Mr. Andrews owns a legal firm. We helped him slash his tax bill by 50% from $500,000 down to $250,000, right? That allowed him to create this free cash flow that he could then reinvest. So what did he do? He invested in stocks, real estate, and then more importantly, he bought another legal firm. So he said, hey, stocks can only get me 10-15% return. Real estate do 15-ish%. But if I invest that money in myself and bought another practice, I could grow a lot quicker. So that's what he did. He was a smart guy, right? So you can do whatever you want. There's no restrictions here within reason, right? So as long as you invest in it passively, then you are perfectly fine. Right, is this legal? You guys are all lawyers, so you should know this one, right? Yes, it's 100% legal, follows all the rules and regulations in 501c3 of the tax code, which has been around for over 100 plus years. Like I said, we've dealt with 287 plus clients, never had any audits, touch wood. We even have a legal opinion letter written by a tax firm, a legal tax firm, that understands our structure and our strategy and have reviewed it. And you all know how hard it is to get a legal opinion letter done. Most legal firms won't even do it, but we paid a lot of money for that because it is valuable, right? We get that second set of eyes on it, get that review. And what your CPA hasn't told you. Let's get into this, right? So CPAs are all about compliance. And most people think that their CPAs work for them. Well, actually, they don't. Your CPA doesn't get paid any more money whether he saves you $1 million or he saves you nothing. He only gets paid by doing more returns for more clients, right? So think about that. His incentive is to have you pay and file so he can move on to the next client as quickly as possible. That's not how we do it. Our incentive is to make sure you save the most amount of money, so we're on the same side of the table, whereas your CPA is on the other side of the table working for the government to make sure you get filed so he can move on to the next number so he can make some more money. No harm, no foul. I get it, right? But I want you to understand that, right? Because most people don't think of it like that. Is that, oh yeah, the only way he makes money is by filing more returns, which is probably why I can't get him on a phone, probably why I can't get an answer out of him, right? So these are all common things that we see day in, day out, every single day. But then also, the CPA is a generalist. It's like going to a doctor and you see a general doctor who knows a little bit about everything, versus if you need brain surgery, you're going to go to a surgeon. It's very different to a general doctor. That surgeon is doing brain surgery every single day. It's the same as a tax specialist, tax savings expert versus the CPA. The CPA is a generalist. The tax specialist is going to save you money on taxes, right? So you don't need to be a generalist. You're too big for that now. That was okay when you were doing 2 million or less. Now you're making multi-7 figures, multi-8 figures. You need a solution. You need a team around you that can operate at that level and to save you the most amount of money. It makes no difference to us, right? It's you who's going to save all of this money. So here's what happens next. So click the button, set up a free call with our team. We'll take you through a rough calculation of how much it could save you, how to stop the bleeding, so that you can stop overpaying the government and keep donating to this government that's in a $39 trillion deficit as we speak. That's not fun for no one, right? So would you rather keep funding that, or would you rather put that money back into your family's pockets so you can grow it for yourselves? Hit this link, scan this QR code, give us a call or a text, whatever you prefer, or even an email on all the social medias as well. Check us out, togethercfo.com. I'm Casey Chohan. Thanks for sticking around.